And now that we're reaching that 200-day moving average, I would expect that these markets will fail pretty heartily from here. I'm looking for a good spot to short and look for back to lower prices. I think we're going to take out the lows we put in over the last down move.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for May 5th through May 12th, 2025, while supplies last. First this week, we feature 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine, and we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. And finally, backdated 1/10-ounce platinum UK Britannia are just $29 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Todd Bubba Horwitz from Bubba Trading. Thank you so much for joining us today, Todd.
Elijah, always great to be with you. Always good information. I look forward to it.
Well, it's great to have you today, and it's always good information that you provide. So I did want to get your pulse on the market today, as we're seeing. It seems like, last time we had you on for a last minute live stream because the markets were collapsing, and now we're seeing kind of a rebound, and we're not back to all-time highs here, but it seems like the stock market is acting very positively over the last couple of weeks here. Your perspective on this turnaround?
No, I think it's pretty natural, Elijah. In fact, we talk about it a lot on our calls. It's just the markets. If you follow market theory, which is the bulls live above the 200-day moving average and the bears live below, we are now back to approaching the 200-day moving average as resistance. So this rally is no surprise. The markets typically get oversold or overbought. And now that we're reaching that 200-day moving average, I would expect that these markets will fail pretty heartily from here. I'm looking for a good spot to short and look for back to lower prices. I think we're going to take out the lows we put in over the last down move. But again, just from theory, again, we go back, you rallied back to resistance, which is the 200-day moving average. I expect the markets to sell off from here.
Now, what kind of downturn do you see? New lows, like the Dow 37,000, I think was around the low this last sell-off. Do you see new lows being made soon?
Yes. I mean, again, I can't say how soon. That's always a hard question, right? I can't time the market like anybody. Nobody can really time it. But the next down move, I think, takes out the previous lows we put in the NASDAQ, in the S&P, and in the Dow. I think we do hit my target of 40 to 60% to the downside. Again, it's not going to be fast, but there's still going to be a lot of pain in this overall market. And right now, one of the biggest problems we're seeing from a trading standpoint is the volatility is too high, the volume is too low, which creates a market that is not liquid, which is why we're getting some of these moves we're getting.
Now, when it comes to the Fed decision coming soon, what do you expect them to do with regard to rates, and how will that impact things?
As much as President Trump wants them to cut, they better not cut. It would be a very big mistake for the Fed to cut rates. Again, that's going to create higher inflation. I understand our debt. I understand our structure, but I think they're pricing in there will be no rate cut. And I do not believe there will be a rate cut this particular cycle. Remember, and I just want to remind everybody, go back to September when they first made their first cut. Your interest rate as a borrower is about 100 basis points higher. The bank's borrowing rate is about 100 basis points lower, which means that the only body did any good with their last rate cut was the banks.
And mentioning the banks, I know last time we had you on for that live stream we were talking about the banking sector as well, how a lot of the bank stocks, maybe down 20% or so at the time. But we have seen a rebound here. Do you anticipate more trouble, though, in the banking sector? Because you mentioned at that point that really this huge sell-off in the bank stocks probably represented, greater issues fundamentally.
Well, I think the banks are in trouble. I mean, again, I'm not going to change my view here. I think they're over-leveraged and they're only being held up artificially here by the Federal Reserve and by what they've done. Hence, the rate cuts were for the banks. I think banks are in very, very big trouble. Again, we don't hear about it until it's too late, but there are many warning signs out there, certainly with the smaller banks and the regional banks that have a lot of trouble already. And I think the big banks, again, are over leveraged as well. And again, remember, we're going to hear, and somewhere there'll be some news that we'll hear that the banks are actually in trouble. But I mean, the mortgage rates, although we had a decrease of delinquencies in March, they're still at record highs, or highs since we haven't seen since 2011. So the lending, the borrowing is a big problem because banks are leveraged at far greater than the 10-to-1 that is allowed by law, which is even too high in itself.
So I know we had issues in 2008 with the banking system. We had issues in 2023 with the banking system. Do you think this will parallel either of those crises at all?
I think it'll be worse. I think it'll be worse than that. Again, I think we built a country based on, lousy jobs. Although the jobs number last Friday was decent, they're not high-paying jobs. We're still spending more money than we're making. And I think that the banks are in for a pretty good beating, which again will really penalize you and me, the taxpayer, because we'll end up having to bail them out once again. So I think that again, I would say that the economy itself, and we expected this, that we expected some pain for Trump to get what he wants and to get the economy back on the right track. There is going to be some pain first, and it'll include the individuals, it'll include the banks, and I think that again we're just going to be the very first quarter of the troubles that we're going to see.
One thing that I thought was interesting, I was listening to Tucker Carlson interview actually with Treasury Secretary Scott Bessent. This was about a few weeks ago here. One of the things he was saying was Trump will never get credit for this, but he is going to be the president who avoids a huge economic catastrophe because of what's happening with the national debt and all of that. Do you think what Trump is doing with respect to tariffs, bringing jobs back, cost cutting, all of that, is that actually going to be, are we going to avoid an economic catastrophe because of what he's doing, or could he possibly be the catalyst for what's ahead?
He could be the catalyst initially, but I think again, we can't look anything from day to day, week to week, or month to month. We have to look over the time and the strength, and the tariffs have been a very big win. I mean, we have collected over $100 billion in tariffs. In fact, we got $17 billion in April. From the tariff exchange. So again, Trump will never get credit for anything. We all know that if something goes wrong in your life, just blame President Trump. It doesn't matter what it is. So we all know that's part of the cycle. But I think Trump is doing 100% the right thing. I think he's taking back over control of the world. I think he's putting us back on top of the board instead of on the bottom. And instead of being the laughing stock, we are now showing and flexing our muscles, which I believe to be the correct thing to do. I think China's getting a lot of trouble. You never get good information out of China. You never know for sure. I think they're in a lot of trouble. I think many other countries are in a lot of trouble, but I think we have the opportunity to pull out the fastest and turn it around the fastest. But we have to stick to a plan, which is, I think, is what President Trump is going to do. And I think that's what Bessent is telling you, that we're going to go through this plan. And yeah, we're going to suffer a little bit. There's going to be some pain. But once we get through the pain, once we get jobs back here, and I'm not talking about the $12 an hour jobs that most people have. I'm talking about real jobs that people can make real money. I think we start and turn it over once we get to that point. But it's going to take time and some pain to get to that point.
Now, I'm still having an issue maybe with the math of all of this, where we have a huge deficit every year, and a lot of what's causing the deficit, like Social Security, Medicare, Medicaid, military, those things you can't easily just cut. But is maybe the argument that with tariffs and bringing jobs home, we'll have more revenue and we'll actually, have more tax revenue as well, even from the American people as we grow the economy, that will maybe be able to get this debt under control? Or what do you think the long game is? Because it seems definitely unsustainable, and even, not that we...
Well, again, it's continuation of devaluing the currency. We're gonna spend $6 trillion this year just on debt service. Okay, has nothing to do with budgets. We have to get a balanced budget. We have to have a president, and we have to have a Congress and a Senate that says, okay, we're going to try to balance this budget and cut things down. Tariffs by themselves are not enough. Okay. Social Security is not an entitlement. Social Security is something that everybody in this country who gets Social Security worked for it. We paid into it ourselves. The government used that money Okay. And with promise to pay it back. Well, when you're running a Ponzi scheme, which is what Social Security is, you're continuing to bring in new money to satisfy old debt. You have to make the adjustment to make the Ponzi scheme work, which means that retirement age should be 80, not 65. Now, you can't take somebody who's in their 60s and say, well, you can't retire to your 80s now, but they certainly have to. At some point, some politician is going to have to step up and say, we need to go to 80 years old. Okay. And whether it's if you're 21 and under, your Social Security doesn't start until you're 80. But right now, Social Security is going to run out in about 10 years, if not sooner. And of course, that is the problem because you built a Ponzi scheme and don't have the funds to back it up. And that's the bigger problem with Social Security and Medicare and other things like that, because people are collecting and we're working much longer. I mean, remember, Social Security was built by Roosevelt. The average living age was 62. You couldn't collect until you were 65. So a lot of people died, never collected. They paid that money in like a tax. They never got to receive the benefit. Now people are living well past 65. And I believe the average living age is now is 78. You have to make that change. If you don't make that change, and of course, what politicians are going to want to change the retirement age when most of their constituents are of retirement age? I mean, the money is still with the older people, and they're still the ones who vote.
And I guess this might be part of the pain that we have to go through, right? That you're talking about.
I think, yeah, of course, there's got to be change. Listen, there's got to be changes, Elijah. We cannot continue. We have to get to somewhere near a balanced budget. You cannot continue to give, all the money we gave to Ukraine. I mean, in the $36 trillion number, what we gave Ukraine is nothing. But when you keep giving away hundreds of billions of dollars, eventually it adds up into the trillions, just like the debt did. I mean, debt at one time was, under $1 trillion. Then it was $8 trillion. Then it was, so at some point you got to draw a line and say enough is enough. And I think that our line has to be no longer should we be supporting the rest of the world with our money. We should learn to support our country and put our people back to work where they're making real money, where you don't mind paying taxes. Taxes should be a privilege. You should be making enough money to not worry about helping your government and paying the money. But of course, you have to downsize the federal government as well. The federal government was never determined to be the largest employer in the world. I mean, we piss away more money on ridiculous things. And of course, Doge has done a good job at what they've done, but they're nowhere near what their target is of cutting in the trillions. They've cut in the billions. But we have to make a lot of changes and a lot of sacrifice before we can turn the corner and actually become a strong nation that is not built on a house of cards.
Now, turning to the precious metal sector, I know last time we had you on, you were talking about how gold would probably be around 3,500 by the end of the year. We've pretty much hit that level already. Now we're retracing back to 32 and change. Your perspective on this continued run, and it seems like a good support along the way. We're not really pulling back that significantly, and we're finding support, it seems like, at much higher prices.
Well, I think they're going to see a pretty nasty sell-off in gold at some point here. Listen, I'm a big fan, so let's not. This is a trader speaking right now. Okay, I'm a big fan of gold. I think we're going to see 2,700 again before the year's over. Okay, I thought we'd hit 3,500. We're well overbought. I think what's perpetrating this rally right now that we're continuing to see is as I've always said to you, there's not enough gold in this country to cover the amount of paper that's written on that gold, right? So you're seeing a little bit of a short squeeze once again, but I do believe that cooler heads will prevail. I think you will see some selling. Certainly, I would not sell any of my physical metals. I would, as a trader, I don't mind being short, but I'm never giving up my physical because we both know that it grows over time. But I think this rally is a little bit too well overdone. I think we're way too far. This goes to the other side of what we talked about earlier, the 200-day moving average. We're about 7 or 8 standard deviations away from the 200-day moving average to the upside, which is way too strong and way too fast. And of course, if you then tie in the silver gold ratio, which is well over 100, it doesn't work that way. And at some point, again, we saw it last week, a couple of days. We had a $140 down day last week. And I think you're going to see more of those coming forward. Long term, buy gold, forget about it, put it away. Short term, I look to sell it.
Now, the gold-silver ratio is interesting because, at least from my experience watching this, it seems like the gold-silver ratio rises when both metals fall, and it falls when both metals rise in general, if we see like spikes in either direction. But if we're going to see a sell-off in gold, it seems like the gold-silver ratio would even go higher then? 100.
No, I think it would narrow because silver wouldn't go down as fast as gold. Silver has not participated anywhere near in the rally that gold has had, right? We went from 90 to 1 to over 100 to 1. Right now, as you and I are speaking at this minute, the ratio is over 100 to 1. Okay. So even if gold goes down, to 2,700 and silver goes down to 30, then we're back under 100, right? And I would look at that type of ratio. I would think that it's going to come down. And remember, the original ratio was set at 15 to 1, and now we're just a little bit above that.
So do you see maybe a greater disconnect than we've seen in the past between gold and silver? Because again, it seems like whenever we see...
We already had the disconnect, Elijah. I mean, when I first started talking about the gold-silver ratio, we were in the 70s. Now we're in the hundreds. I think that silver's an outstanding player. I also think platinum's an outstanding player because I don't think they'd be as damaged. I mean, you want to trade? A futures trade, sell gold, buy silver, buy platinum. I think you have a much higher probability of bigger profits. Again, I think that gold is due for a pretty good beatdown, whereas silver really hasn't done anything all too exciting. I said I thought it would get to 35, which it did. But again, I think it will go higher. But I think, again, lower first. I think the markets are going lower first. I think gold is mathematically way too far from the mean. I don't think there's enough money to support the kind of movement we're seeing right now.
Sounds like possibly a great buying opportunity coming up here if gold gets to 2,700, as you mentioned. I did want to move to commodities here. Last time we had you on, you were talking about how oil was selling off. Where are we right now in the commodity sector?
Well, I mean, oil's to me is going into the 40s. I mean, it's 57 now, but I think again, this is all part of the plan. You got OPEC now participating. They're pumping in more oil now too because they want to try to keep out the American producer, right? So they want to make the cost prohibitive that we can't drill because it would be drilling at a loss. I think they're wrong. I don't think it's going to work. But again, if 80% of our economy scrolls around the oil market, which it does, because again, from making lipstick to plastic bottles to driving your car to delivery to all the things we do, about 80% of our economy is fossil fuel. If they come down, then that brings inflation down naturally, where we can still have high demand for product, but we're not paying as much to deliver to get it. So it brings the inflation down. And I think the rest of the commodity space, I think that you're now starting to see in the grain markets, they're starting to find a little bit of strength, although lower today. But I think they're starting to find a little strength. And I think we're going to get back into normal type ranges and normal type movement. But unfortunately, the inflation is still not under control yet. And I think that's the first step will be if crude continues to go lower, which I believe it will.
Well, that's positive then, it sounds like. I mean, if we actually see prices fall, that would be fantastic for the consumer here.
No, it would be. I mean, again, just think about how much gas you use yourself. I mean, average person, let's say, uses $100 a week. It's $5,000 a year. If you cut that in half, that's $2,500 a year. That's a pretty good savings for the average consumer. And I think that's where we're headed to. Again, I think that was Trump's agenda anyways, drill, baby, drill. And I think that's where we're going to go to. And I think as we continue to go lower, it does ease inflation. And it will, again, obviously prices, no matter what happens to oil, the companies are not coming down, but they'll come down a little bit, right? But the companies, Starbucks never dropped their price, even though every time coffee went higher, they raised it. But when coffee is lower, they don't do anything. So, but overall, the cost of production, everything will come down and we'll get better pricing, which will bring down inflation, which will give the average American more money to spend.
Moving forward here, your macro view, though, on the markets, I guess, wrapping up here, it sounds like really you should have a lot of caution if you're playing in the stock market right now, because we're kind of at the end of that dead cat bounce and you're looking pretty soon for another leg down.
I look for a leg down, but you have to determine, are you trading this or are you investing in this? Because I could be wrong. Okay, I don't have to be right in my opinion. And I have not, I'm still over 100% invested in my investment portfolio. Okay. So again, if you're investing, I don't think you can time the market. You just buy it and play it. If you're trying to trade it, then I would wait or I would be selling. Okay. Which is exactly what I'm doing. I'm short from a trading standpoint, but my long-term, my retirement, all my other money is still 100% invested in the market. And that's the way you have to determine, am I a trader or am I an investor? Can I take the pain of the next downturn? Certainly, if any of you is investing now, taking 25% of their investable money and putting it in now, even though it's high and I think it's going down, they could buy more if it goes down lower, or they could buy a little more if it goes up, and I'm wrong. But either way, you're in, you're participating, because sitting in cash is losing money because the value of the currency continues to go down every day, no matter what.
And if our viewers are interested in learning more, they'll find an affiliate link to Bubba Trading in the description of this video and that code there. Any last thoughts before we let you go, and tell us a bit about your work?
I think it's just be careful. Again, investors should never even look. Again, take your smartphones, turn them off. Don't look at your account every day. It doesn't matter if you're investing. If you're trading, then look for high probability setups. Markets get extended one way or the other. Doesn't matter what your opinion is. Your opinion is wrong, just like mine is. If the market is too overbought, look to sell it. If it's too oversold, look to buy it. And we teach, we educate, we put products together. We have programs. I mean, I teach how to hedge, which is why I can say, and which is why I was so happy during the last downturn, because I kept buying more stock. And look what happened. The market came all the way back up.
Fantastic. Todd, Bubba, Horwitz, thank you so much for your time today, and God bless.
Always a pleasure, Elijah. Thank you so much.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for May 5th through May 12th, 2025, while supplies last. First this week, we feature 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine, and we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. And finally, backdated 1/10-ounce platinum UK Britannia are just $29 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.